Hello, everybody. I'm Cheree, the Money Lady. Today's session is Mortgages 101 for Realtors. During today's conversation, we're going to talk about as you're sitting in front of a borrower, how do you know, some of the basics of mortgages. And then how do you know if you're sitting in front of somebody that's not completely qualified, but they may have some sort of concerns, and you may be able to say, hey, no, you know what? I took this Mortgages 101 class from this really cool woman, and she said that that's not a concern. So, as you are looking for people to purchase homes as realtors, one of the things you want to get people to do is agree to a loan application, especially if they're going to buy within the next 3 months, or get with the lender in order to ask whatever questions they have about changing jobs and things like that. And we're going to hit on some of those topics today. So, I'm the Money Lady. I am licensed with Envoy Mortgage. And let's get started. Now, I do work with a lot of investors, but today's conversation are for primary homeowners. So everything I'm going to talk about today are for primary homeowners. Actually, about 65% of my business comes from primary homeowners, and the other 35% comes from wealth building investors. So some of you may know me from Grid or some of the other real estate investment communities that I'm a part of, which is why I wanted to put this note up here. Agenda for today, we're going to talk about a little true or false game playing that we're going to do. We're going to talk about the 5 foundational pillars to mortgage lending. Talk about some of the loan types that are out there. Will your borrower qualify for a loan? We're going to talk a little bit about how you can do an initial assessment to see. Talk a little bit about down payment assistance and how a lender makes your offer more competitive. So, we're going to talk about all of those things today. Okay, so the first question that we have, true or false? When the Fed lowers interest rates, mortgage rates also go down at the very same time. If you answered false, you are correct. This is not a true statement. So, what happens with mortgages is mortgages and mortgage rates are based on the 10-year bond market. The Fed rate is exactly that. It is the rate that the United States government pays for the debt that it has. And also, a lot of credit cards move with it and other kinds of debt. But mortgages are not a one-to-one relationship. With mortgages, they actually look at what the Fed is doing and they ask themselves, what do we think the Fed is going to do with rates over the next 12 to 18 months? So, in some environments, let's say we believe the Fed overall, as a market, is going to reduce rates 2 times over a 12-month period, over the next upcoming 12 months. Well, if the Fed ends up lowering rates 3 times over that 12-month period, then you'll start to see the mortgage rates go down. But if everyone, on CNN and CNBC and, The Economist is saying we expect mortgage rates to go down, and mortgage rates actually, sorry, we expect Fed rates to go down, the Fed to cut rates, and then rates actually go down. And it's the amount that everyone within the consensus expects, then the mortgage rates are not going to go down like 1 to 1. So I always like to bust up that myth. Okay, next, true or false? My borrower has a 720 credit score. They're going to get the absolute lowest rate out there. This is also false. This is also false. So the truth is that the best rates go to people with like a 760 credit score or higher. But the people who have 720 credit scores are going to get good rates. They're going to get good rates. So um, it's the reason why I mention this specific item in the true or false is because you will hear people say on the news, for example, um, currently right now the rates are 6.38%. And you may be talking to somebody with a 720 credit score and they may be quoted a 6.5% rate, for example, when they are getting their loan or getting a loan estimate for a property that they're looking at. It doesn't necessarily mean it's bad. It's just a, mixture of uh, debt to income ratio and assets that they have and their credit score and a bunch of other things that goes into the rate that they're actually quoted. So, all right, next thing, true or false? A lender is offering a lower rate. My borrower should automatically work with that lender. If you answered false, you are absolutely correct. Um, I will tell you right now that I have had people go with other lenders and then contact me and say, my lender cannot close my loan for me at all. Or they didn't tell the underwriter everything, and now my EMD, my earnest money deposit, is at risk, right? So, one of the things that you want to encourage your borrowers and buyers to do is think about who is the lender that I trust that's not going to blow smoke up my butt, but it's actually going to tell me the truth during the entire process. So, next thing, true or false? My borrower has bad credit. He can't get a loan. If you said false, you're absolutely correct. So, the lowest credit scores that are fundable, honestly, there are some lenders that will do as low as a 500 credit score. Now, between a 500 and a 580 credit score, a lot of lenders don't do loans for those credit scores, but it can be done. You're just going to have to call around and until you find a lender that can actually do it. It's something called manual underwriting, but it can be done. We don't do it, but it can be done, right? And actually, if you contact me, depending on what state you're in, I might even have a resource for you. And you're gonna pay sky high rates, so can't have it all, right? They may have to pay points, they may have to pay sky high rates, so just letting you know that now. 580 to 640 makes the person eligible for the FHA loan, but it's not just about having just the 580 credit score. It also, we'd have to do something called automated underwriting, AUS automated underwriting system. And we run that in order to get something called an approved eligible within the system. And this is not just Cheree's system or just Envoy system. This is the system. Fannie Mae, Freddie Mac, FHA system, right? Will give the person something called an approved eligible. So if the person has a 580 credit score, it depends on what is happening within that person's credit that is derogatory is the term that they use. But yeah, if somebody says, "Oh, I don't think I can qualify for a property. I think my credit is 610." No, they can qualify. They can qualify as long as they have some of the other items taken care of that we're going to talk about today. I've also had people who thought they had credit in the mid to high 500s. True story. I had a client who we ended up closing on her house where she thought she had, mid to high 500s, and it turns out her credit was 610. Her credit was 610, about 613, something like that, and she was able to close on a house. So, does happen. Okay, true or false? My borrower has to put down 20%. If you answered false, you're absolutely correct. Your borrower, depending on who your borrower is, and the biggest thing is, do they qualify for a conventional loan or an FHA loan, or are they a veteran, active or a veteran? Can they get a VA loan? Can they get a USDA loan? They don't have to put down 20%. Okay. There are some loans where they don't have to put down any money. And I actually had a veteran over the summer that not only didn't have to put down any money, but he didn't have to bring any money to the closing table either. So that does happen. Um, all right. Next, true or false? Um, oops. Yeah. My borrower must have his down payment as cash in a bank account. My borrower must have his down payment as cash in a bank account. If you answered false, you are absolutely correct. We have borrowers that will either borrow against or take money out of their 401ks or their retirement accounts in order to be able to purchase a house. And it's usually up to $50,000. It'll depend on the borrower, where they have their money, things like that. But they can get their down payment and closing costs from retirement accounts. So they don't necessarily have to have cash. True or false? My borrower is switching jobs. He has to wait 2 years in order to qualify for a loan. That is false if. False if the person is going from being an RN, for example, at one hospital to an RN at another hospital. Are they going to a new job? That's the same type of job. Or true story, I have a borrower that is going from being a general manager at a was it a general manager at a like a Walgreens or Rite Aid or something like that to like another similar type of company being the GM there. Perfectly fine. My joke is always a person cannot go from being a chef to being an astronaut. At that point, they do have to wait the 2 years. But if it's something similar that they're doing, then that is absolutely fine. Okay, true or false? My borrower just graduated college. He cannot get a loan. If you answered false, you're absolutely correct. We have recent graduates that have been able to get loans. So all we need from them is their college transcript and then a hopefully a job offer letter and their first pay stub before they close on the property. But I've gotten pre-approvals for people with a college transcript and a job offer letter. So absolutely. Okay, will your buyer qualify for a mortgage? Let's say you're sitting in front of somebody and they're like, I want to buy a house, but I don't know if I'm going to qualify. I'm going to give you just like a 101 overview. The point is not for you to tell the person you absolutely will not qualify for a house. The purpose of this section is to let you know how we as lenders look at the building blocks for mortgage qualification so that there are some borrowers that are saying, I want to buy, but I don't know, that you're able to get them over the hump to say, yeah, you can actually qualify for a mortgage. All right. Income, debt, credit, assets, property. All right, we're going to talk about each of these things because each of these are important, and unfortunately, you can't not have one without like the others being there. If one of these is missing, then for the primary home buyers, if one of these is missing, then oftentimes you're not going to be able to get alone. There is one caveat, and that is if you have a person who has a lot of money, a lot of money, a lot of assets, and they don't have a job, I've got a loan for them. But outside of that, if it's just like a regular schmegular person, is what I call them, they really need to have all five of these things. Okay, let's talk about income. Job stability is the big thing, or income stability. So some people work W-2s, some people have their own small business, some people are 1099s. Where do they get their income from, and has it been stable over the past 2 years? Some people are 100% commission. Some people are, W-2 with commission. We work with all sorts of people, but have they had income stability or job stability over the past couple of years? I was speaking with a borrower, and unfortunately, she had job stability, but her spouse did not. Her spouse was unemployed for about 6 months over the past 2 year period. And I'm like, ugh, you know, and they needed that income in order to qualify for the property. So there wasn't anything we could do there. If the person hasn't been working 2 years, but they've been in college, perfectly fine. College counts as job stability. So, again, all we would need from the college graduate is their transcript, as well as a job offer letter, or if they've started working. Like I have one borrower right now who started working, and we're getting him a pre-approval letter because we have income for him in his college transcripts. For my self-employed people, you're either going to need your taxes, you're going to need 2 years of taxes, or we need 12 or 24 months of bank statements. And I will tell you right now that the bank statement loans, we have been closing bank statement loans for our self-employed people. Most of the time, most of the time when people tell me they're self-employed, they're most of the time not going to get a conventional loan because of the way their taxes are set up. So just something to think about. All right. But I always start off with what does the person want? If the person wants as little out of pocket as possible, we always start off with asking for taxes to see if there's a way for us to do that. If not, we have to move over to the bank statement loan. Okay, we just talked about income. Let's talk about debt. And you may have heard of this thing called the debt to income ratio. This is one of the main pillars with regards to people getting mortgages. And the very rough concept of this thing is you have to have $2 of income for every dollar of debt. $2 of income for every dollar of debt. That's roughly a 50% debt to income ratio, which for conventional loans, for VA loans, there's a certain debt to income ratio that we have to stay underneath. USDA loans is lower than this. FHA loans is about 55% debt to income ratio. But we do like you don't have to worry about that piece of it. Just know that the debt to income ratios are different based on the loans. And what I do is I'm a strategist, so I work with your borrowers in order to figure out what loan product is going to work for them based on a myriad of factors, including their debt to income ratio. You may be asking, okay, so what is debt? What is the debt? Let's go back here. Your debt is everything on your credit report. And somebody asked me this yesterday. It's the monthly payments on your credit report. So if you have student loans, if you have another mortgage on an investment property or another house that you don't intend to sell, if you have credit cards, what are the minimum monthly payments on those credit cards? And then the debt is also going to include the house that your borrower is about to purchase as well. So that is all pulled together in order to figure out what your debt, what the borrower's debt is, and then you're going to have income, and that's your debt to income ratio. Okay. Next thing, will your buyer qualify for a mortgage? Let's talk about credit. Minimum credit score, we already talked about this a little bit, 580. You're going to get more options, and your borrower is going to get more options, or your buyer, sorry, is going to get more options with a 640 credit score. And then they're going to get the best rate and options with a 780 or higher credit score. And it just, I will say this as well. If your borrower is self-employed, and we need to use bank statement loans or asset loans, then we're looking at a 660 or higher for those. But, we have some options here. We really, if we're doing any kind of credit repair for people, we really try to get them at a 640 or higher. For down payment assistance programs, sometimes people need to be at a 640 or higher as well. Sometimes they can get away with a 600. So, all right, let's talk about assets. Oh, I have here credit scores. See, I messed that up. Four simple ways for people to boost their credit scores. They can increase their credit card limits, which will then decrease their utilization. They can pay down their credit cards. They can make their credit card payments before it reports to the credit bureau. So, what do we mean by that? They're able to call their credit card companies and ask the servicer, like, hey, I am trying to pay off my credit cards before you actually report to the credit bureau. So usually, let's say the settlement date or the settlement date for the credit card when they actually report is like the 10th of the month. Your buyer may say, I'm going to pay this credit card on the 5th of the month, give it a few days for it to actually go through the system and show a $0 balance due in order for me to like be more favorable with increasing my credit score as well as the debt to income ratio. And then, of course, paying out debts on time for an extended period, it's just common sense. But, for some people who really need to work on their credit scores, that is part of it as well. So let's talk about assets. Your assets are going to cover the amount of money that people need in order to close that loan. So they need assets or money for down payment and closing costs. Is there down payment assistance? Yes, we're going to talk about that. Is there closing cost assistance? Yes, if the seller is willing to give seller credit. But we always start off with, can that person pay their own down payment and closing costs? All right. Uh, Down payments anywhere from 0 to 5% are the minimums, whether they're getting a VA loan, USDA. First-time home buyers with conventional loans can be 3%. A lot of people don't know that. They will contact me and say, I need to go FHA. I need to go FHA. And I'll say, why? And they'll say, because I need a 3.5% down payment. I'm like, well, you can do a conventional loan with 3% down, and they don't know that. So 3% first time home buyer conventional loans. And also there's an other option for people who make, I think it's 80% of the area median income can also put down 3% as well. FHA loans, also great for first time home buyers. 3.5% is the minimum down payment. And then 5% non first time home buyer conventional loans. So those are your minimum down payments. I had a mentor of mine give me a great acronym for figuring out how much the closing costs are going to be. So for the cash to close, including the closing costs, there's the acronym DELTA, DELTA, like the airline. So D stands for down payment, which we already went over. E stands for escrow, L for lending fees, T for title fees, A for appraisal, and A for anything else, including points. Okay? I know not exactly spelled like the real airline Delta, but you get it. Escrow. If somebody asks you what escrow is, I always just describe it as a savings account. When somebody goes to a bank in order to open up a new account, they get an account number, right? And then the teller will ask them, okay, well, how much do you want to put into this bank account in order to actually open up this account? It's the same thing with escrow. Escrow is a savings account. It's every 6 months. The county will send a bill with regards to the personal taxes for that buyer of 123 Main Street. And instead of the buyer having to come up with thousands of dollars twice a year, instead they send that bill to the loan servicer or the lender, and the lender has money in that escrow savings account that's available to pay those taxes. So they write the check, or send it electronically to the county, and that's how the taxes are paid. Same thing with homeowners insurance. So when people are asking what escrow is, that is the way that I explain it to them. For lender fees, there are, you know, different costs that people charge. Our lender fees happen to be quite competitive, so we don't charge very many lender fees at all. And then for points, for us, we don't charge points unless somebody wants to buy down their rate. So cash to close at the very bottom, it says down payment plus 2 to 5% of the purchase price. What we do for our clients is once we have a pre-approval for them, we'll say, okay, based on this house that like we'll find a house, for example, and we'll say, okay, this house is 500,000. That's how much you qualify for. We'll give them a little sample loan estimate with what their monthly payment is going to be and what their cash to close is expected to be. And again, this is just an estimate for them. Obviously, it'll depend on the final house that they select and things like that, but it gives them a pretty good idea of how much you're going to have to bring to the closing table. And again, the assets or this money can come from savings, checking, money market, brokerage account, retirement account. I didn't put on here, but it is true that it can also come from gifts from family and friends. So I had a borrower who got $35,000 from mom in order to go towards the purchase of his home. So that is possible as well. Gifts are possible as well. All right, the last thing with regards to your buyer qualifying for a mortgage is the property itself. So, yes, this is a joke on the right-hand side, but this is also serious as well. Uh, how is the property built is one really big thing. Is it something called site built, meaning that the construction company brought the wood, they brought the cement, they brought it all to the land, and they actually built it from the ground up? Is it a manufactured home? Is it a condo? Is it a mobile home? I will say that with some manufactured homes, actually all manufactured homes, not all loan products will fund manufactured homes. So if you're working with a buyer and you're looking at the MLS at a property they like and it says it's a manufactured home, you need to get your lender on the phone right away or email them like, hey, buyer's really interested in this property. Based on the loan type that you have them in, is this going to work? Mobile homes are like practically 100% not going to get funded with traditional loans, not conventional FHA, things like that. Again, if you find a mobile home, send it to your lender first before your buyer goes out there, you and your buyer get in the car, waste your gas. But I have yet to see a mobile home get funded through us. I usually have to send that to somebody else who funds mobile homes. Condos. Condos are a little tricky as well. There are two types of condos that are out there. There are warrantable condos and unwarrantable condos. A warrantable condo is a condo that can be funded by Freddie Mac, Fannie Mae, FHA, right? An unwarrantable condo are condos that cannot be funded through these entities. Most condos are unwarrantable. So, if you have a buyer that's going to go see a condo, again, connect with your lender first. Ask, hey, can you find out if this condo can be funded based on the loan type that my buyer is going to have? Because I've had listing agents call me and I've had buyers agents call me after they've already put an offer on the property. And we could save your gas and your time. So And then finally, the property is, will it appraise for the sale price? If it does not appraise for the sale price, then the buyer needs to cover the difference between the appraisal and the sale price. You probably have had that come up, or will have it come up in your education as agents. But yeah, the appraisal is also another big thing with regard to the property itself. From a lending point of view, we don't necessarily care what the home inspection says. The only time I've seen it really come up is if there were like we have some people who are on wells and the water showed E. coli, and then the lender, the underwriter required that there's another inspection showing that the bacteria is gone before they'll fund the loan. But that's all that I've really seen with regards to, and that's not really a home inspection thing. That's just the county for that for those buyers required those kinds of property inspections, and the lender or the underwriter is asking for that information. So, okay, so questions I ask your buyers during our first conversation. These are the questions that I ask. I call it impact. Again, this was something that was taught to me. I didn't make this up. Well, I made up part of it, but impact. I ask them what their income is, where they're getting their income. Is it stable? How long have they been at their job? Are they a W-2? Or are they self-employed? Things like that. I ask them their monthly payment. What monthly payment would they feel comfortable paying? And I include within that monthly payment taxes, insurance, and any HOA or condo fees. So I also ask them about the property that they're interested in. What city are they interested in? Are they buying in a rural area? Are they looking at manufactured homes, or, and for example, if the person, I won't necessarily say you're looking at manufactured homes, but if I know that area has a lot of manufactured homes, I'll say to them, to the borrower, like, hey, can you send me a couple of links to Zillow that you're looking at, just so I can get an idea of what kind of property you're interested in. I'll ask them what their target purchase price is. If they've looked already, if they haven't looked already, where they are in the process with regards to the property. Assets, I'll ask them about their assets. You know, where is the money for down payment and closing costs? If it's in a retirement fund, I'll ask, are they currently working at that company or not? Things like that. Do they need down payment assistance, etc.? Now, I won't ask if they need down payment assistance. They'll have to tell me, no, I absolutely need down payment assistance. But if they do, then we have a couple of programs that's available. C is credit. I'll ask them, hey, roughly what's your credit score? Now, most people inflate their credit scores. So if I have a person who says, "Oh, my credit score is, 700," like perfectly fine. If I have a person who says, "I think my credit score is 600," or Credit Karma says it's 600, that's when I will want to do a soft pull and actually check their credit score sooner rather than later. But I do ask about, where they think their credit is. And then the final thing is the time frame. So with time frame, I want to know when they want to close on their upcoming home. And then what I do is I work my way back 3 months. So if a person says, I want to close by the end of December, then I need their loan application completed the beginning of October. And the reason for that is it gives you and I enough time to get their application done, to get a pre-approval, for them to search for a home, put offers on homes, get an offer accepted, go through the process of underwriting and inspection and appraisals and all of that, and get them to the closing table by the time that they're looking for. So I always do a 3 month buffer. If the person says, I'm looking 12 months from now, I'll keep up with them until that 3 month period, unless I think there's a credit issue. If there's a credit issue, I'll have them apply right away, do a soft pull of their credit so that way I can make sure there's not a credit issue. Okay. Types of loans that are available, all sorts of loans that are available. Conventional loans, which are traditional loans. There's FHA loans, which are great for people with low down payment or higher debt to income ratios. For our military people, both active and retired, the VA loan. For people who want to buy in rural and some suburban areas, the USDA loan. I'll tell you one little thing about the USDA loan. Because yes, it is 0% down, but the debt to income ratio is lower. It's like 41%. So it depends on the person and the person's numbers if a USDA loan is really going to work with them. I will say this though, I've closed plenty of rural properties with a conventional loan. So if somebody's buying rural, conventional loan is perfectly fine. We can get them in. First time home buyers, 3% down in rural areas with the higher debt to income ratio. Um, our jumbo loans are for people who are buying more expensive properties. So right now, the loan limit is 806,250 in the Northern Virginia area. So, and that number goes up every year. But anything above that, we're looking at jumbo loans. 203K loans. I love these loans as well as home style renovation loans. If a person is willing to buy a property that is a fixer upper, and I'm not talking about a money pit, right? But just it's a great house. It has great structure, great character, but maybe carpets need to be done. It needs to be painted. It needs a new kitchen, new bathroom, new roof. The landscaping needs to be done. The person can do and use a 203K loan or a home style renovation loan. So, my self-employed people, bank statement loans are really great. Either we're going to get 12 months of your bank statements or 24 months of your bank statements to get you approved for that loan. 1099 workers, there are 1099 loans where you're able, this is for people who only get like one 1099. They like work one place, but they're not W-2 salary. Instead, they get a 1099. There are 1099 loans that are available. Profit and loss loans. These are stated income loans for, again, my self-employed people. Rates on these are going to be a little bit higher, but I'll tell you, I am giving somebody a quote today for these loans. Now, this guy makes a lot of money. Don't get it twisted. But um, he is going to he doesn't qualify for conventional because of the way his taxes are done. But we looked at a bank statement loan at 6.75% and a profit and loss loan at 6.875%. So he's going to pay a little bit more if he wants the P&L loan, but there's less paperwork. So we'll have to see which way he wants to go. Next is the asset utilization loan. This is for people who have a lot of assets but low income. Sometimes senior citizens, sometimes people on disability, sometimes people inherited money. They're going to put more money down, 25% for these loans, but they don't have to show W-2 income and all of that stuff. The loans, the mortgages are just based on the assets that they have. Unwarrantable condo loans. So I had told you before that there are certain condos that can be funded by FHA, Fannie Mae, Freddie Mac, and then there are others that are not funded through those traditional methods. Well, there are other loans out there for unwarrantable condos. I will tell you right now, minimum down payments 10% for those. So I-10 loans. These are for workers without social security numbers. So these are available. Foreign national loans are available for our international buyers who are not U.S. citizens and don't live in the United States. Last time I saw for these loans, they were closer to 50% down. So just letting people know that. And then one-time close ground up construction loans. This is for people who want to buy land and build from the ground up. These are available as well. So the um, last few loans here are alternative loans. They do have higher down payments and interest rates, slightly higher interest rates. And they do require a 660 plus credit score. So again, just something for you to think about. But there are a lot of different lending solutions out there for all sorts of buyers. Down payment assistance. We have nationwide programs, we have local programs. Oftentimes, we do need an extra 5 to 10 days to close on those loans. So these are not going to be fast closings, 21 days or even 30 days. We may ask you for 40 days in order to make sure that everything is in line. So if you're speaking with me and we are working with a borrower that needs down payment assistance, I will let you know how many days we actually need in order to get closing done for those borrowers. And you can also couple the down payment assistance with seller concessions, and the person can get in with no down payment. And they can also get in with no money for closing costs if you negotiate enough seller concessions for people. So, okay, how can I work with the lender to strengthen my buyer's offer? If we are in a super competitive uh, state or area or marketplace, a fully underwritten pre-approval, that really does help tremendously. Also, lenders who work on the evenings and weekends. So, I do that. Sometimes some of the big box banks, they don't work evenings and weekends, and that makes a big difference when your listing agent needs to contact the lender in order to ask follow-up questions. Lender calls listing agent within 6 hours of submitting offer. That's something that I do. So I learned not to do it right away when you submit the offer. But if you CC me on the email when you're submitting an offer, I wait about 6 to 8 hours and then I call the listing agent. By that time, usually the listing agent has looked over the offer. They may have spoken with you about it. They may have already spoken with their seller about it. And I'm there to just strengthen that, like, hey, we've run AUS. I had talked about that before. That's the automated underwriting system. We've reviewed income, we've reviewed assets. This is a really good loan, and this borrower is, really solid with their financials. Lender tells listing agent she ran AUS or ran the DU. DU is digital underwriting, desktop underwriting. Your listing agents that have been in the business a while knows exactly what this means, and they're like, oh, this lender truly is on top of it. And then a local lender as well. So our office is in the Reston area. I personally am in Maryland, but I came up to college in 1993 to come to American University. And, but I work with a lot of different people across um, Maryland, DC, Virginia, West Virginia, and then I'm actually licensed in 8 states. So that is the entire conversation for today. If you want to call or text me, 571-583-4600. And I'm just here to be of service to all of you as you are looking to help more and more buyers. And that's it. So I'm the Money Lady. Thank you so much. And I hope to chat with you soon. Take care. Bye.